Every single day, you are fed a beautiful lie about financial freedom. You see the fake gurus flashing supercars, smiling on yachts, and promising that a few dividend stocks will fund your dream life while you sleep on a beach. It is a multi-billion-dollar illusion. They show you the luxury, but they hide the graveyard. They make real wealth look like an overnight miracle, leaving you trapped on the financial treadmill. This is not a polite investment guide. This is a cold, calculated wake-up call. No corporate fluff. No optimistic nonsense. Today, we shatter the passive income myth with unvarnished mathematics. You will discover the exact, raw number required to buy back your time from the corporate machine, and you will see the brutal traps designed to wipe out your savings. Let us stop pretending the stock market is a magical money printer. The exact second a company pays you a dividend, two silent economic assassins are already waiting to destroy it. The first assassin is the tax man. Gurus love showing massive gross returns on clean spreadsheets. But gross returns are a fantasy. Dividends are taxed immediately in the year they are paid. Depending on your country, the state will automatically ambush your payout, cutting away 15, 20, or even 30%. If your portfolio generates $4,000 a month, taxes can instantly drop that to $3,000. Your path to freedom is violently choked before you even touch the money. The second assassin is even more ruthless. Inflation. If you build a static dividend portfolio with a fixed payout, you are losing wealth by design. A check that covers a comfortable life today will barely buy basic survival rations in 15 years. The currency loses its purchasing power every single day. If your dividend income does not aggressively grow every year, your dream of freedom turns into a struggle. You are fighting a war against a depreciating currency. Now, critics of dividend investing will tell you that dividends are irrelevant. They say total return is all that matters because a dividend payment simply drops the stock price. But they miss the real point. A calculated dividend growth strategy is not about day trading stock prices. It is about building predictable, automated cash flow so you never have to sell your shares during a terrifying market crash. To bridge this gap safely, we look at the intersection of a conservative dividend yield and the historical 4% rule. If a balanced portfolio yields an average of 3.5%, you can safely live off the cash flow while keeping your principal capital fully intact. Let us apply this 3.5% net yield to three brutal levels of reality. Level 1. Basic security. You need $1,000 a month, $12,000 a year after taxes. This covers electricity, basic groceries, and absolute essentials. Run the math. 12,000 divided by 0.035. The price of pure survival is $342,000 of cold, invested cash. Level 2. Middle-class comfort. You want $4,000 a month, $48,000 a year. This covers a decent home, health care, and standard family expenses. Divide that by 3.5%. The price tag on a normal middle-class life without a boss is $1,370,000. Over $1 million just to live a normal life. Level 3. Total independence. You target $10,000 a month, $120,000 a year. The formula requires a massive portfolio of $3,420,000. Seeing these numbers drives most people to despair. They assume they can never save that much from a regular salary. And that panic drives them straight into the jaws of the ultimate market trap. This is where amateur investors make fatal mistakes. They panic at the sight of $1 million target, and they desperately look for a shortcut. They open investment apps, sort by the highest yield, and see distressed companies screaming, 10% dividend yield, 12%, 15%. The math looks intoxicating. The trap is set. The investor thinks, if I buy a 12% yield, I only need a fraction of that million. Welcome to the dividend slaughterhouse. A massive dividend yield is almost never a badge of corporate health. It is a flashing red warning of a dying company. When a business model fails and debts accumulate, institutional investors dump the stock. The stock price crashes. Because dividend yield is a ratio, the payout divided by the stock price, a collapsing price makes the yield explode upward. It looks like a gold mine, but it is a decaying corpse. You pour your life savings into this high-yield trap. A few months later, reality hits. The company cuts the dividend to zero to avoid bankruptcy. The stock crashes another 80%. Your passive income vanishes. Your starting capital is vaporized. Safe dividend investing is painfully, agonizingly boring. It means accepting lower yields of 2 to 4% from bulletproof corporate monopolies that have increased payouts for decades. So how do you actually win this game? How do you accumulate over $1 million without a massive inheritance? You do not save your way to freedom. You invest. You weaponize compound interest through a structured dividend reinvestment plan. The DRIP strategy. Let us look at a real hard calculation. Imagine you start from zero and invest exactly $500 every single month. We will assume a conservative average return of 8% per year, consisting of a 3% dividend yield and 5% capital appreciation, with all dividends automatically reinvested. During the first 10 years, the progress feels painfully slow. You have contributed $60,000 of your own money, but the portfolio is only worth $92,000. Your annual dividend is just $2,700. It feels like a joke. This is where 90% of people quit. But look what happens if you hold the line. By year 20, your personal contributions total $120,000. But the compounding snowball has rolled your portfolio to nearly $300,000. By year 30, the geometric math shifts into overdrive. Your out-of-pocket contributions are $180,000. But your portfolio value has soared to approximately $750,000. At a 3.5% yield, your shares are now generating over $26,000 a year in purely passive cash flow. The money generated by your assets has overtaken your monthly savings. The snowball grows entirely on its own momentum. Let us face the final, uncomfortable truth. Living off dividends is a tangible reality, but it demands a price that most consumers are completely unwilling to pay. It requires a fundamental shift from a consumer mindset to an asset owner mindset. It requires you to consistently prioritize buying income-producing assets over short-term discretionary spending. Relying on traditional savings or a government safety net is a dead end. The only way to win is to stop being just a consumer and become an owner. An owner of real businesses that pay you simply because you hold the shares. The math is on the table. The choice is yours. Are you going to keep running on the treadmill, or are you going to start building your exit strategy today? First, maximize your savings rate to feed the engine. Second, avoid the temptation of dangerous high yields. Third, automate your reinvestments and let time do the heavy lifting. Calculate your personal baseline number. What is your realistic target to cover your life?